Get ready for the action, because we are kicking things off with a deep dive into the semiconductor world. We are looking at Micron Technology and how they stack up against their key competitors in the industry. We'll break down the financial metrics, examining Micron's lower debt-to-equity ratio and impressive growth to see if they are truly positioned for massive success in this competitive landscape.
Tired of dropping your phone or struggling to hold it with one hand? The PopSocket's Pop Grip gives you a secure grip, works as a phone stand, and even lets you swap the top for a fresh new look. Simple, useful, and perfect for everyday phone use. Click the link in the comments to grab yours on Amazon.
Next up, we shift focus to the undisputed giant, NVIDIA. We are going head-to-head with its competitors in the semiconductors and semiconductor equipment industry to see what drives their incredible performance. We'll analyze NVIDIA's outstanding profitability metrics, including its massive EBITDA and gross profit, and explore how its market position is shaping the future of artificial intelligence. Now, we turn our attention to the heavyweight champion, Samsung Electronics. We're exploring the intense internal dynamics at Samsung Electronics, specifically the ongoing performance-based pay debate and the resulting labor management conflicts. We'll look at how this internal friction is shaking up the future competitiveness of this semiconductor powerhouse. And finally, we look at the global manufacturing engine, Taiwan Semiconductor Manufacturing Company Limited, or TSM. We'll examine the recent movements in its stock, including the selling activity by First Eagle Investment Management, LLC, and review the strong analyst sentiment surrounding TSM's valuation and future projections. Don't miss out on this crucial market update. Stay with us. Micron Technology is demonstrating a strong financial profile when benchmarked against its competitors in the highly competitive semiconductors and semiconductor equipment industry. As a major global player specializing in memory and storage chips, Micron's revenue is primarily driven by dynamic random access memory, or DRAM, with secondary exposure to NAND and flash chips, serving diverse sectors including data centers, mobile devices, consumer electronics, and industrial applications. The company maintains a vertically integrated structure. A detailed financial analysis reveals several key strengths. Micron exhibits a relatively stronger financial position compared to its top 4 peers, evidenced by a low debt-to-equity ratio of 0.15, suggesting a reduced reliance on debt financing and a favorable balance sheet. Furthermore, valuation metrics point toward potential undervaluation. The price-to-earnings, PE ratio, stands at 0.25 times the industry average, while the price-to-book, PB ratio of 12.38 is 0.89 times the industry average. The price-to-sales ratio of 15.51 is also significantly below the industry average, all signaling favorable growth potential. Operational performance is equally compelling. Micron boasts a return on equity ROE of 21%, which is 13.51% above the industry average, indicating highly efficient use of shareholder equity. Profitability metrics are robust. Earnings before interest, taxes, depreciation, and amortization, EBITDA, reached $18.48 billion, more than 4 times the industry average, and gross profit hit $17.75 billion, $3.49 times higher than the industry average. Perhaps most strikingly, Micron is experiencing rapid expansion, reporting a revenue growth rate of 196.29%, significantly outpacing the industry average growth rate of 33.43%. These combined metrics underscore Micron Technology's strong financial health, superior profitability, and significant growth trajectory within the semiconductor landscape. An in-depth analysis comparing NVIDIA with its top 4 competitors in the semiconductors and semiconductor equipment industry reveals a strong financial position and exceptional performance metrics for the technology giant. Key financial indicators suggest NVIDIA holds a favorable risk profile. Specifically, the debt-to-equity ratio for NVIDIA stands at 0.07, indicating a stronger balance between debt and equity compared to its peers. In terms of valuation metrics, NVIDIA appears relatively undervalued based on certain comparisons. Its price-to-earnings, PE, ratio of 44.78 is 0.3 times lower than the industry average. However, the price-to-book, PB, ratio of 33.9, which is 2.69 times the industry average, and the price-to-sales, PS, ratio of 24.91, which is 1.43 times the industry average, suggest potential concerns regarding overvaluation based on book value and sales performance, respectively. Despite these mixed valuation signals, NVIDIA's operational performance is outstanding. The company demonstrates superior profitability and growth across several critical areas. NVIDIA boasts a return on equity, ROE, of 31.11%, significantly exceeding the industry average of 24.22%, pointing to highly efficient use of equity. Furthermore, its earnings before interest, taxes, depreciation, and amortization, EBITDA of $51.28 billion, is 20.03 times higher than the industry average, signaling robust cash flow generation. Gross profit also stands at $51.09 billion, marking a 16.32 times outperformance against the industry average. Perhaps most compelling is the revenue growth trajectory. NVIDIA is experiencing remarkable growth at a rate of 73.21%, significantly outpacing the industry average of 40.67%. NVIDIA's dominance stems from its leadership in developing graphics processing units, GPUs, which have evolved from gaming enhancements to becoming crucial semiconductors for artificial intelligence, powering large language models. Beyond hardware, NVIDIA provides a comprehensive software platform, CUDA, essential for AI model development and training, alongside expanding data center networking solutions to support complex workloads. This combination of leading-edge technology, strong financial health, and aggressive growth positions NVIDIA as a powerhouse in the evolving semiconductor landscape. Samsung Electronics cemented its dominance in the global semiconductor market in 2017, surpassing Intel to claim 14.6% of the worldwide market share. This achievement is attributed by some analysts, such as Professor Shin Sung-Siop of the National University of Singapore, to Samsung's union-free management style, emphasizing that organizational flexibility and integration are crucial for navigating rapid technological change and continuous large-scale investment. Professor Shin suggests that consensus-based consultation can impede the necessary speed and agility of the semiconductor industry. However, the relationship between labor and management at Samsung is currently strained by controversies surrounding performance-based pay incentives. This internal conflict has escalated beyond traditional labor management disputes, activating broader societal tensions concerning relative deprivation and compensation structures. The government has intervened to avert a potential semiconductor strike, but the underlying gap between labor and management persists. The debate over performance pay is now manifesting as a non-no conflict within Samsung, affecting various business units and leading to the emergence of terms like Samsung, not the former latter. Experts fear this internal friction poses a significant threat to Samsung's future competitiveness, overshadowing the immediate financial implications of the incentive packages. Furthermore, a wider industry trend, the N% debate, calling for guaranteed operating profit percentages as incentives across major industries, has gained traction. This controversy highlights a shift in mindset, suggesting that the past belief that company success automatically translates to individual growth is fading. There is a call to critically assess whether performance metrics reflect individual contribution or industry coincidence, questioning the justification for removing significant operating profit percentages as incentives. Industry observers are urging both labor and management to heed warnings about the potential pitfalls of excessive short-term incentives, suggesting that accepting union demands for incentives could set a dangerous precedent across the Korean industry. The central challenge facing Samsung Electronics is whether it can sustain its historical adaptability and super gap capabilities amidst these evolving internal and external pressures. Taiwan Semiconductor Manufacturing Company Limited, NYSE TSM, has seen recent activity across institutional investment portfolios and analyst ratings, supported by strong recent earnings. First Eagle Investment Management, LLC, reduced its stake in TSM by 11.4% in the fourth quarter, selling 761,682 shares, leaving the firm with 5,938,326 shares, which constitutes 3.2% of their portfolio. This makes TSM their fifth largest holding. The firm's ownership stake was valued at $1,804,598,000 at the close of the quarter. Other significant portfolio shifts were noted. Stevens Consulting LLC significantly reduced its position, lifting its stake by 82% in the fourth quarter, resulting in a holding of 91 shares valued at $28,000. In contrast, Ares Financial Consulting LLC acquired a new stake valued at $29,000, and Resources Management Corp. CTADV and Maziko LLP both acquired new stakes in the second and fourth quarters, respectively, with values of $32,000 and $35,000. Institutional investors and hedge funds collectively own 16.51% of the company's stock. Separately, Cedar Wealth Management, LLC, reduced its holding by 91.4% in the third quarter, now owning 134 shares worth $37,000. Market data shows that TSM shares opened at $404.07 on Tuesday. The stock exhibits a 52-week trading range between a low of $184.61 and a high of $420. Key technical indicators include a 50-day moving average price of $362.07 and a 200-day moving average price of $331.93. The company holds a market capitalization of $2.09 trillion, with a price-to-earnings ratio of 33.62 and a beta of 1.39. Financial performance remains robust. Taiwan Semiconductor Manufacturing reported earnings data on February 10th, posting an earnings per share, EPS, of $3.11 for the quarter. The company achieved a net margin of 46.97% and a return on equity of 38.17%, with total revenue reaching $30.65 billion for the period. Analysts anticipate the company will post an EPS of $15.25 for the current fiscal year. Insider activity is also present, with VP Borzentine purchasing 1,000 shares on March 22nd at an average cost of $55.93 per share, increasing their position by 12.42%. Insiders have collectively bought 1,346 shares in the last 90 days, representing 1.11% of the total stock ownership. Analyst sentiment remains largely positive. Recent reports include Wall Street Zen upgrading the rating from hold to buy on March 22nd, Wedbush reiterating an outperform rating on February 11th, and DBS Bank upgrading to a moderate buy on January 23rd. Freedom Capital issued a strong buy rating on January 15th, and Needham & Company LLC raised its price target from $410 to $480, maintaining a buy rating on April 16th. The current consensus rating across analysts is buy, with an average target price set at $404.29. TSMC is recognized as a leading pure-play semiconductor foundry, providing wafer fabrication and services across logic, mixed signal, specialty processes, and advanced nodes critical for mobile, high-performance computing and AI applications.